Our economic outlook has expected a mild global recession for a while now. We continue to expect that outcome, but so far have been surprised, particularly by the resilience of the US economy. That resilience has been driven primarily by a number of special factors that are unlikely to repeat into 2024. A moratorium on student debt repayment, a very significant fiscal stimulus at the beginning of 2023. So as those temporary factors roll off, what we're left with is significantly tighter financial conditions. Central banks around the developed world have raised interest rates really aggressively in order to bring inflation back to target. Bond yields have tightened. Credit availability has weakened. That contributes to a tightening in financial conditions, which is consistent with a weakening in economic activity as we go forward. We're starting to see that weakness in the Canadian economy. The Bank of Canada's tightening is really beginning to bite. In the third quarter, though, there was a general indication that policy interest rates will stay at current rates well into 2024 in order to slow the economy and get that progress on inflation control. Even though we continue to expect a mild global recession, we're beginning to see opportunities in asset markets. In our TAA positioning, we've begun to look for opportunities to deploy cash. In our core economic scenario, we see a 10-year US Treasury declining from current levels close to 5% down towards 4%. That's an attractive opportunity that's beginning to develop. We're taking advantage of that opportunity by shifting in our tactical positioning from overweight cash into overweight investment grade fixed income. We also have recently shifted to a more neutral tactical position on Canadian equity. When we look at fair value now, Canadian equities are trading broadly in line with long-term valuation metrics. The TSX has really gone sideways for 2 years. At the same time, corporate earnings in the Canadian market have grown quite strongly. Those two facets have brought the valuation down to a much more neutral level. So whilst the outlook in the near term for the Canadian and other equity markets is still at risk from our expectation of a mild global recession, longer term Canadian market is setting up to be relatively attractive and a likely outperformer.